You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, and welcome back to the Infinite Banking Mastery Podcast. Today, I wanted to talk about infinite banking and velocity banking and how there are some similarities and also a lot of differences. So I just kind of wanted to clarify between those two things because I feel like a lot of people think that they are one and the same, but they are not one and the same. As most of you regular listeners know, the core idea behind the infinite banking concept, which was developed by Nelson Nash, is to utilize a whole life insurance policy as a place to build a pool of cash from which you can finance future needs and also be able to access income tax-free all through your life and in retirement. Your cash value within the policy will grow with compounding interest, uninterrupted, even as you borrow against the policy. It's part of its magic. As your cash value grows, so does your equity in the policy that you own, as well as your personal banking system. Some of the key features of infinite banking is that we are leveraging whole life policies, not any version of a universal life policy, only whole life, and the cash value of the policy grows tax deferred. As a policyholder, it is very easy to borrow against the cash value of your policy, such as there are no credit checks, for example. And because when borrowing the money, you are borrowing the insurance company's money rather than withdrawing your own money, then there will be interest due to the insurance company. In order to grow your banking system, you would want to pay yourself an interest rate over and above the rate that the insurance company is charging. And the money borrowed against the policy's cash value is not considered taxable income. And the death benefit is tax-free for beneficiaries, in most situations anyway. However, if your contract were to become a MEC, then borrowing against the earnings in your policy will be taxable. And also, borrowing against or withdrawing any earnings from the policy will be subject to the 10% early withdrawal penalty if you are younger than 59 and a half. Now, what is velocity banking? It is a strategy focused on debt reduction. It involves using lines of credit to pay off debts more quickly. I would say the most common line of credit that is used is a home equity line of credit, a HELOC. And so here's a high-level overview of how it works. First, you would want to secure the line of credit. If not a HELOC, then maybe a personal line of credit. Using paying off a mortgage as an example, you would then use the available amount on the line of credit to pay down the mortgage. So let's go through an example. Let's just say you opened a home equity line of credit, a HELOC, for $40,000. Once that line of credit was approved and opened, you would then use that $40,000 and pay it down onto your mortgage. Then you would send all of your paychecks to the line of credit. So instead of your income being directly deposited as it normally would be in your checking account, that money would go directly into your new HELOC, all of your income directly into your HELOC. By doing this, you are then also paying down the HELOC by as much as you possibly could each month, because all of your income is paying it down. This will minimize your interest charges on the HELOC. You could then use a credit card to charge everything you need for the month and then pay that down before any interest is charged. So let's say that you have $5,000 in disposable income at the end of every month. In this example, it would take you 8 months to get that $40,000 paid back to your HELOC. And then you would just plop another $40,000 down on your mortgage. Taking these steps, you are able to reduce the overall interest paid on the mortgage and accelerate debt repayment. It would be ideal if you were also able to get an interest rate on your HELOC that's at least as low as your mortgage or lower. Now, this only works if you have positive monthly cash flow at the end of every month. If you're spending more than you make each month, this definitely is not going to work. So as I said earlier, some people think that infinite banking and velocity banking are one and the same, and they are not. However, you can use your whole life policy to pay down debt from outside banks very efficiently as well. In fact, we help our clients with debt pay down sheets. We create these debt pay down sheets and plans all the time for people. You have more control and flexibility with your whole life policy loans. And instead of being dependent on the bank allowing you a line of credit, you are building equity that you own within your whole life policy. Your whole life insurance loans are very efficient, being that each loan repayment that you make goes 100% to the principal. This allows you to pay down the loan as fast as you possibly can because the insurance company isn't keeping half or more of the loan repayment for interest and then applying the difference to your loan balance, like credit cards do or like your mortgage. They apply the full loan repayment to your principal balance. This keeps your interest charges as low as they possibly could be. Building equity that you own inside of a life insurance policy is going to be superior to building equity in your home. As home equity can go up and down with the market, you are also at the mercy of the bank allowing you to borrow the equity. When you're building up equity and cash inside of your whole life policy, you're just building up a bunch of cash to do whatever you want with that you own, and cash is king. Building equity in your life insurance policy is also growing a guaranteed tax-free death benefit for your family. The death benefit from which additional riders are based on for access to cash if big medical conditions were to show up in your life, such as the critical, chronic, or terminal illness riders. With velocity banking, there are no additional benefits and no death benefits. Some advantages of velocity banking, which are also advantages of infinite banking with a whole life policy, velocity banking can significantly speed up the process of paying off debts. Again, we help our infinite banking clients with this as well by building those debt pay down spreadsheets, especially for those with lots of debts who are trying to streamline their payoff process. Another advantage of velocity banking is that while using a line of credit with a lower interest rate, you would be able to lower the overall interest paid on your debts. With infinite banking, the amount of cash you would have access to as a loan will depend on how well you've been funding your policy, but then your loan rate is likely to be one of the lowest rates available on the market, or maybe just the lowest rate available on the market. It depends, of course, on what the rates are in the market at that time. I would say the interest rates on loans with insurance companies that you can borrow at right now are probably some of the lowest that have ever been. So if you acquire a policy now with a company that has the option for a guaranteed fixed loan rate, then you get to lock that in for the rest of your life. Ultimately, velocity banking requires careful planning and disciplined cash flow management to ensure the HELOC is effectively used for the personal line of credit without accruing excessive interest or debt. So, infinite banking focuses on building wealth, providing financial flexibility, tax-free access to your cash, leaving a tax-free legacy, and velocity banking aims to accelerate debt repayment to ultimately reduce the total interest paid. And again, a version of this can also be done through the use of a whole life policy, but we're not doing the exact same thing. We're not shoveling our whole entire paycheck into the whole life policy and then turning around and paying off debts as quickly as we can. We're not putting our whole paycheck in. So that's definitely one difference. Also, velocity banking doesn't provide any tax benefits. That's something else to note. Some other differences: infinite banking provides greater control over your personal finances, with you deciding when and how to use the cash value as the policyholder. Be sure to keep in mind that velocity banking involves the risk of fluctuating interest rates. So you might start off with a nice low rate, and then you have to be careful because if that rate goes up, you have to be able to afford and keep being able to pay down your HELOC. For whole life insurance, different companies have different rates, and some have fixed loan rates and some have variable loan rates. There is one company that I know of where you have the option to switch back and forth from fixed to variable loan after it's been at least 1 year from your last loan. That's pretty unique. Now, there are ways to combine velocity banking with infinite banking, although not everyone is a good candidate for that. If you are interested in this, or simply starting up your own whole life plan to get started on building your own banking system, and would like to partner with me to get started, feel free to reach out to me at valerie@alphaomegawealth.com. So I hope this was helpful to you or helped to clarify this further for those of you who have been wondering. I appreciate you listening to today's podcast and hope you have a great week. Take care.
This is thepodcastfactory.com.